The stock market seems to be breaking down fast. We're going to look at what retirement investors can expect going forward. So stay tuned for the full episode. Here's a headline from billionaire Jeff Gundlach. Fed will keep raising rates until something breaks. Here's a look at the 30-year fixed mortgage rates. You can see they peaked over 7%. We're slightly below 7% right now. What's causing this? We've had high inflation. The CPI, Consumer Price Index, as high as 8.2%. And most recently, the Personal Consumption Expenditure Price Index, known as the PCE, came in at a rate of 4.9% higher than expected. This is the inflation indicator that the Fed uses to determine how high they want the interest rates to go. Welcome back. This is Richard with Wisdom Investor. The stock market continues to drop lower. And those with retirement nest eggs, especially in the stock market, are very concerned. We're looking at a weekly chart for the S&P 500. Let's just recap what's going on. We had the pandemic, the Fed lowered interest rates, the government threw a lot of money at the markets. We had a big move to the high side here in the stock market. We also had other things going on. We had a lot of people throwing money at the stock market, wanting to take advantage of the market as it was going higher. We also had the Robinhood guys going in there and running after stocks, throwing money after specific stocks, not investing, but driving the price higher, ganging up on stocks to drive the prices higher. Well, now the situation has reversed. We reached extremes. Typically what happens in the market, you reach extremes. Well, we reached extremes to the high side. Fed comes in, starts raising interest rates to slow the market down. The markets don't like that. Therefore, the S&P 500 is down about 25% for the year 2022. We're looking at the Fed funds rate. This is the expectations for the Fed's policy rate. What they're expecting is that rates continue to go up till the end of the year, then they stay high through a good portion of 2023. This is what has investors worried. So we're starting to see a lot of fear in the markets now. Last time we looked at this report, this number here was at 24. Now it's dropped down to 15. The lower it gets, the more fear. I've seen this as low as 4%. The fact that Fed has been raising rates has not slowed down inflation, and this has investors worried. Despite the higher rates, inflation continues to move higher. Now, the price of gasoline has been dropping. That's a bit of good news. Also, despite the rise in interest rates, unemployment is still relatively low. We're going to take a look at the effects of the sell-off in the markets. Now, here's some potentially good news. We're looking at the S&P 500, the number of stocks above the 50-day moving average. If you notice with this sell-off, the number of stocks above the 50-day moving average is below 5%. Back in June, before we had a nice bounce up, the stocks reached a similar area. If we look over to the far left, we'll see it during the pandemic. And let's make it clear, we're not in a pandemic right now or the same type of situation. But when the number of stocks above the 50-day moving average drops to these extreme lows, eventually the market starts to push back higher. What does it mean when a stock is below the 50-day moving average? We're looking at a stock here for Nike. The 50-day moving average is this blue line here. So when the stock price is below that blue line, that's below the 50-day moving average. The 50-day moving average is an average of the stock prices over a 50-day period. We're looking at a chart down below of the New York Stock Exchange. We're looking at the advancing volume. And we can see right here, the advancing volume has reached extreme lows. When was the last time it reached these extreme lows? Is when we were during the pandemic days. Here's a chart of the S&P 500. Let's scroll down here. We'll look at this chart. This is the new highs, new lows. This is a chart of the New York Stock Exchange high-low list. You can see here we've reached, here's a chart of the S&P 500. You can see out to the right here, the price is dropping. We're going to look at a corresponding chart. This is from the New York Stock Exchange, the high-low list. You can see here as the market has moved lower, we've reached extremes. Here's a chart down at the bottom of the New York Stock Exchange. Again, looking out to the far right with the market moving down. We're looking at the breadth indicator here. This is giving us a reading on the advancing and declining stocks. You can see we're reaching extremes to the low side. Over here, back in the pandemic time period, we also reached similar lows before the market started to turn higher. So what I'm pointing out here, we have reached some extremes to the downside due to the selling in the stock market. We reached similar extremes in June. The market then bounced up. It's very possible that we're getting to a new inflection point where we do get a bounce higher. However, there's no guarantees. The more fear that we get into the markets, the closer we are to a bottom in the selling. So the bottom line is the market reaches extremes to the high side, and then it also reaches extremes to the downside. So we have to reach a happy medium at some point. Now the biggest thing that's coming up is going to be the earnings reports of company stocks here in the next couple of weeks. That will indicate how the market's going to continue to move, whether we start to get a bottoming action here and start to eventually move higher, or are we going to continue to sink lower. So I hope this information here was useful. Thanks for watching. Stay tuned for our next update.